Welcome everybody, episode 4 of The Grow. I am your host, Scott Sinclair, and this week we'll be talking about a comment from a listener related to stock market prices, market valuations of publicly traded cannabis companies. This is episode 4 of The Grow, as I said, and by now you'll be getting the hang of it. This Grow podcast is about business fundamentals applied to the business of cannabis. It's about leadership, it's about management, it's about controlling the things that you can control. It's about making more money, improving cash flow, restructuring fundamentals if you need to do that, raising capital, creating shareholder value, and realizing on that value. This episode is brought to you by Sinclair Range. As usual, Sinclair Range, there is a link in the notes and it helps all businesses, including cannabis businesses, raise capital, turn around operations, restructure debts, and generally execute on all of the strategies that we talk about on this podcast. Go check it out, Sinclair Range, at the link, and reach out to discuss for free any of your specific situations. Before we get started on the main topic, I saw an interesting story on the weekend, and I just wanted to cover it here. I normally try not to talk about things that are outside of our control because there are so many things outside of our control in this industry, but I thought this particular story was poorly covered by other sources, and yet it was interesting. So the report is that Israel has targeted Canadian cannabis imports, so as a Canadian exporter into Israel, so Israeli imports have been tariffed 165%, even more than the Chinese 145% tariffs put through by Trump. So Israel is targeting Canadian cannabis. Its Ministry of Economy has announced plans to impose steep import duties. The move stems from an allegation of product dumping against cannabis companies from Canada. Local Israeli cannabis cultivators have been complaining about the dumping and the low cost from Canada. They can't compete, which is probably true. I have no knowledge, firsthand knowledge about this one way or the other, but I have worked in Israeli cannabis and their growing costs are pretty low. And so if they can't compete, that's probably evidence, I would think, of some dumping. Let me know if you believe that to be true in the notes and the comments, please. So there was a formal investigation, January 2024, 126-page report, and there you go. The levies are different. The tariffs are different by Canadian company. Decibel would face 12%, Village Farms 28%, Organogram, I can never say that, Organogram 53%, Tilray 70%. We'll talk more about Tilray today. However, most others would be hit with the full 165% rate, some of them even up to 175%. And this is not passed yet, but it needs final approval, but it looks like that is what's going to happen. For context, I looked it up, between 20 and 23, so that 3-year period in total, Israel imported 78,000 kilograms of medical cannabis from Canada. In total, with about 80% of that coming from Canada, so 62,000 kgs. 23 alone, it was 16,000 kilograms of cannabis, and their domestic production reached around 51,000 kilograms. So Canada is a big part of the Israeli market. Maybe if it's dumping, that's why. I'm not saying that it is dumping. It just looks probable to me. In fiscal 2023, Israel accounted for one third of Canada's total cannabis exports by weight. So why am I covering that? Just a reminder that we live in very uncertain economic times and a shifting landscapes in all businesses, but particularly in the cannabis industry, which is, we have uncertainty in regulation, uncertainty in trade wars, like this Israeli-Canadian cannabis tariff. We have uncertainty in capital markets, banking, just uncertainty everywhere in the cannabis industry, which is all the more reason for this podcast to focus on business fundamentals and diversify product risk, diversify geography risk, diversify regulatory risk, diversify everything you can, and to focus on your business fundamentals. All right, Morningstar Equity Research. Have you ever heard of them? Morningstar Equity Research covered a recent Tilray earnings release, and they put a target on the price for the stock price at $2.40. That's Canadian dollars. $2.40 on April 8th, so just last week. It said, the research report said that Tilray reported its fiscal third quarter 2025 earnings with net revenue declining 1% year over year to $186 million for the quarter. However, excluding the effect of currency, net revenue would have grown 2%, and adjusted EBITDA, well, actually, let me address this net revenue issue first. So it says if you held currency constant, the revenues actually would have gone up a little bit, not down. And what that means is that Tilray was exposed to a particular currency that devalued, so net exposed to a currency that devalued year over year. And by doing, and probably Canadian dollars, because that's what they were reporting in this particular release. And so if you just held that current, in fact, their operating revenue stayed pretty flat or went up 2%. Adjusted EBITDA margins declined by 60 basis points to 4.8%. As a reminder, a 60 basis points is 0.6%. So a 0.6% decline. So basically flat. And by the way, of course, if they had done in this research report, if they had adjusted for flat currencies, probably the EBITDA would have been slightly up as well. And then the research report says that given that Tilray remains in a growth stage, increasing sales is important for achieving scale, expanding profit margins, and reaching consistent positive free cash flow. Headwinds in cannabis and beverages are likely to weigh on top line growth. Tilray remains in a growth stage, says this analyst report. Analysts in cannabis are terrible. Absolutely terrible. They are out of touch. They are wrong. And this is an example of that. It makes me even wonder if this was written by a human or was this written by artificial intelligence. Are we getting there in the equity research, just pumping out useless AI-driven reports? Maybe that's what this is. Why are analysts in cannabis terrible? Because analyst research in an investment bank or anywhere is a cost center. No one pays for a bunch of research. It's not a profit center. I'm not saying never, but damn near never. It is a cost center. And if there's no banking profits to be made in the sector, why would you put your high-priced business school grads from the Ivy Leagues that you pay a bunch of money to, why would you throw them into the cannabis sector? Put them somewhere else where you can make some money on the banking trades and the banking services that you provide, which is what research supports. That's what you do. You don't put them in cannabis where you can't do any deals and you can't make any money. Do you think that this sector attracts the highly paid super smart analysts? Absolutely not. And you just see that throughout this industry. Everything you see from analysts in cannabis, you need to think to yourself, wow, why is that guy in the cannabis sector? That doesn't make any sense. Is Tilray really in a growth stage? The prior year quarter included revenue of $6 million. So the prior year of $6 million that is now discontinued SKUs. Strategic initiatives and SKU rationalization impacted revenue by $13.2 million in the current quarter. That's from the Tilray release. They are purposely cutting back on revenue. They're not increasing. They're not in a growth stage. They're cutting back on revenue by eliminating unprofitable SKUs so that they can increase their contribution margin, not necessarily gross margin, but contribution margin. I'll explain that in another episode if I haven't done so already. Gross margin increased 200 basis points, which is, again, 2%, to 28% in the third quarter compared to 26% in the prior year. They are reducing revenue to increase their margins. It's right in the Tilray release. And the analysts at Morningstar, if this is a human being, missed that entirely. You know what else they missed? Tilray reduced our outstanding debt by $71 million with convertible note reduction of $58 million, strengthening the balance sheet. I think they converted a bunch of debt to equity. As a result, net debt to trailing 12 months EBITDA is less than 1 times. They look at a ratio of cash flow from operations. As a proxy for that, you would use EBITDA, and you divide that to your debt, or you take your debt and divide it by your EBITDA, and you want to keep that under, say, 3-4 times maybe in this market. Well, they're below 1. They have very little debt, and they have $248 million in cash, including marketable securities. And so Tilray says they have great flexibility for strategic opportunities. They have a $485 million market cap when I wrote these notes on the weekend. And the working capital alone in that company is $424 million. They're trading at basically asset value. So if you are focused on business fundamentals, on growing your business, having a healthy balance sheet, being in a good cash position, increasing your margins, which is the first thing that you need to do to earn more profit, which is what this show is about. If you focus on business fundamentals, this was a really, really positive release by Tilray, and the analyst just has it wrong. Back to that report, with the Canadian cannabis market still challenging, Tilray has directed volume internationally and exited low profit categories. This helps near-term margins but sacrifices potential growth. Who cares? Get your fundamentals right before you scale. You cannot scale on a rotted foundation. You got to get your margins right. Meanwhile, its beverage alcohol business faces challenges from declining popularity of craft beer, and it goes on to slam hemp-derived THC beverages as well. So the focus of the week, as I said, on the Grow episode number 4, is public market valuations and stock pricing versus fundamentals and intrinsic value. Well, this Morningstar equity research calls for Tilray stock to be at $2.40 per share. Reminder, that's still CAD, Canadian dollars. And at the time of the report, it says right in the report, the market was 64 cents. $2.40 was their estimation of value, what the shares were worth, and market was at 64 cents. So when I started preparing the notes for this on the weekend, it was at 49 cents and then 47 cents when I turned the camera on this morning. This research report is wrong, but also the market doesn't care what the research report says. Like, by multiples, it doesn't care. The comment from the listener, which started the content that we're doing today, or the theme of today's episode for you, was on the Cresco Labs episode that we did. When was that? Was that episode 2? We talked about a killer earnings release from Cresco Labs. And one of the comments on that was, I forget what platform the comment came through, but it said, hey, these Cresco Labs people are shit business people because stock prices keep declining, and the person making the comment had lost a fortune on the stock, and therefore they're bad business people. Well, here's what we all need to understand. There are very few public companies, I mean really very few of any size in any industry, that have a share price, a market price, that is truly reflective of the intrinsic value of that company. Intrinsic is another word for inherent or fair market value. It's what the business is really worth absent a market on a standalone basis. Okay, and if you're a business valuator like I am, what you are doing is you are calculating intrinsic value. You can't account for what the market might be doing. You can't account for M&A valuations. We'll talk about those another day. And so very few companies, public companies, actually trade at or around their intrinsic value. And the ones that do are mega cap companies because they have such a large volume of market and people interested in trading that you start to create that holy grail of an efficient market. But even in the mega cap stocks, you often see bubbles. You see bubbles on, like in the AI industry right now and in other industries. You can't tell me that you think that if you're old enough to remember the dot-com bubble, that those stocks were anywhere near intrinsic value. That was all just based on hype. Well, for small capitalization companies, which you are if you are public in the cannabis industry, the industry as a whole has fallen out of favor, and the market price does not reflect value. That should be your working assumption, that the market price really has nothing to do with the intrinsic value of the company. Why is every cannabis stock now a small capitalization, publicly traded company? Why is that? It's because no one cares. No one cares about the stock. There's no bids of any significance anymore. People want to get out. Nobody wants to get in. So the market price does not reflect at all intrinsic value. Sometimes the market price is way overvalued. That really happens not because it's been bid up, not because there's hype, but it values because the market hasn't caught on to the fact that the company is toast, it's going to file insolvency, it's going to go into a receivership or a CCAA in Canada, and the stockholder is going to get crushed, and the market doesn't understand that. We saw that many times. I've covered it in other content that I produce. You can go look that up as you want, and we'll watch that. So sometimes it's overvalued, not because it's been bid up, like I said, but because the intrinsic value has gone to zero, and no one in the markets is paying attention to realize that. But a lot of the times, it's undervalued. It's undervalued because the intrinsic value of the business is going up because the management is focusing on fundamentals, yet the stock price isn't going up because no one cares. The only way to succeed at this is to keep your head down and focus on business fundamentals and just disassociate. Disassociate the idea that the business fundamental improvements will actually drive the stock price. That does not happen. As counterintuitive as that sounds, it doesn't happen. You think you're going to put out a great release like Cresco did, and I see this Tilray is not a great release, but certainly a positive release from a business fundamentals perspective. You think the stock's going to pop. It does not pop. It just doesn't. Why? Because no one is paying attention. So disassociate that. If you want to have a public company right now in this sector and you want to succeed, you need to think about your business and the fundamentals, and then you need to think about your stock price as an entirely different business that really has not much to do with the first business of making cannabis and trying to make money on that. You need a separate business plan for your stock, for your trading volumes. Treat it and manage it completely separately. Enter stock promoters, enter market makers, enter investor relations, public relations, all that stuff. I don't want to get into that. As you know, I think you should be not public right now. I think you should all be looking at whether going private makes sense for you. I'm not saying 100% of you, but a lot of you. If you're going to try and promote your stock, it's not going to come from business fundamentals and intrinsic value. It's going to come from treating your stock as a separate product which you market and manage. Or better yet, you can just ignore the stock price. Who cares? Focus on fundamentals, which is what both Cresco and Tilray appear to be doing. Or better yet, as I said before, go private. Do your deals, restructure, go private, and then, 3-5 years from now, whenever the markets turn, whenever the industry is back in favor and you've been focusing on fundamentals, go public again and you will get lots of value and make lots of money. That's it for this week. This has been The Grow, episode 4. Wherever it's going to help a lot, wherever you're listening to this podcast, go there and subscribe, and like, and participate. Reach out with a link in the notes, as this person did on Cresco, and give me some inspiration of things that you would like to talk about. Suggest some topics. And that's it. We will talk to you next week.